If you plan to retire early, is it best to get on COBRA, or do you go directly to healthcare.gov if you're retiring before being eligible for Medicare? We've got that and more coming up. Welcome to the Wise Money Spotlight, where we spotlight a question from you and topic, all to help you take your next wise step in your financial life. My name's Mike Bernard. I'm your host, and with me in the KFG studios, health insurance expert Ben Bulgrien. Ben Bulgrien has been on the team for several years now and serving, a lot of clients. We're helping with their health insurance needs, whether that is before retirement or transitioning onto Medicare, helping them take their next wise step in their financial life. And that's what we're tackling today, Ben. Jumping into a question from a fan of the show about retiring at 57. Well, do I go on to COBRA or healthcare.gov? What's the process like when you're looking for health insurance after you retire, but before Medicare?
Sure.
Yeah. All right. So, Ben, we're going to take a hot take question and start with what's the number one Medicare question that you field? What's the number one question you get about Medicare?
So what almost everybody asks me when they come in to meet with me is, Ben, once we get signed up, can you stop the advertisements that we see every single night all day long? And I tell them yes. I said, anytime you meet with me, we'll get them closed.
There you go.
However, in exchange for that, everybody else is going to see more.
Yeah, there you go.
So we've had a net zero impact on the advertisements people see. But no, really what people tend to come in asking is, when do I need to sign up? Because there's a lot of well-intentioned people, a lot of well-intentioned documents out there that say, hey, you need to make sure to sign up as soon as you turn 65, or you could face penalties.
Yeah.
And that is not always the case. So I'll meet with people that are working, they have employer coverage, and they just want to make sure that they avoid these penalties. However, in certain situations, they might be able to delay for a while without getting penalized. But everybody is saying, no, you need to do this at this point because otherwise you're going to face a penalty for life.
Well, and that kind of aligns with your joke of how aggressive and how much pressure people feel because they're just, you get all sorts of mailings and phone calls, and you feel like, oh my goodness, I'm more likely to make a mistake than I am to get it right.
Yep. And so that's why we like to meet with people, regardless of what their health insurance situation is, just so that we can make sure that we are giving the advice that is specific for their needs.
Yeah, that's a little bit of a teaser. Didn't know you were going to directly go there, but Ben's going to be back in the studio in just a couple of weeks answering that very question. Really, what's the process? When should you start that education for Medicare, learning about the differences? When should you start meeting with an expert? When do you apply? When does it start? We're going to be hitting all of that when Ben's back in the studio. Okay, so Ben, retiring at 63 and a half used to be fairly common. I started my career a couple decades before you did, but it used to be fairly common. People would hold on, even if they were financially, if they felt ready to retire, they would wait until 63 and a half because they would be eligible for COBRA. COBRA, when you retire, it can last for 18 months, sometimes in certain instances for 3 years, but 18 months. And then that would take them to 65 when they're eligible for Medicare. Are you still seeing 63 and a half and then transitioning on to COBRA? Is that a common strategy that you're seeing?
So I would say 63 and a half is, I have a smaller subset of individuals that are there. I do see in 2026 more people electing COBRA as their the continuation of their health coverage than going to a healthcare.gov or a marketplace plan.
Why is that?
Because of the sunsetting of the advanced premium tax credits, the enhanced ones. So there are still advanced premium tax credits available for individuals that are getting their health insurance through the marketplace. However, fewer people are qualifying for those than they have for the past handful of years.
So essentially, when they originally created the Affordable Care Act, Obamacare, whatever, there was a cliff, meaning if your income was below 400% of the federal poverty level, then you received some advanced premium tax credits, blah, but you were able to pay a lesser amount on a monthly basis for your health insurance.
Right.
But if you were even 1% over that, you got nothing.
Yep. Right.
Well, they changed that after COVID or during COVID to, instead of having a cliff, it was like a ramp. It was just a slope. And so it didn't just completely drop off. And yeah, over the past year or so, a lot of politicians, they've been just arguing over, well, can we extend that slope?
Right.
Can we keep it around? Because it was set to sunset. And you're saying, as of right now, as of the time we're recording, it's still sunset, meaning it's back to a cliff.
Back to that cliff. And so the real life impact for some people, this wouldn't necessarily be the COBRA situation, but I had a handful of clients that I met with that were paying $400 a month for their insurance in 2025. Their income didn't change. And in 2026, they're paying $2,400 a month.
Oh my goodness.
And so when COBRA would not be an option for them because they had been on the marketplace last year, but when we're doing a comparison of, well, you can pay $2,400 a month to get a plan that has a $10,000 deductible, or you can go on COBRA that's going to be $2,000 a month, and it'll be the exact same medical coverage that you have been used to. It's a much more attractive option than it has been in the past. It doesn't mean it's right for everybody still, because there are still people that will qualify for those tax credits, especially when they're considering a retirement or change in their income situation. So it isn't across the board. Yeah, COBRA is definitely a great option for everybody, but more so than it has been in the past.
And those are just examples, obviously, that Ben's sharing. But I want to hear from you. What are you on healthcare.gov? And were you getting healthcare, the advanced premium tax credits, or are you still expecting to get them now that the cliff has been reinstated? Are you considering COBRA? Are you considering a different option? Love to hear your comments below. All right, let's get into a familiar question. And yeah, it's always a concerning one. This one came from listener Ed. My wife and I have saved aggressively, and we're looking to retire next year at age 57. I assumed that we would take COBRA for as long as we're able and then get health insurance through healthcare.gov. Does that sound like the right plan? Or should we get our insurance through healthcare.gov right away? Also, we plan to spend some time in warmer climates. Will that impact, or how will that impact our health insurance decision? So a lot to unpack there, Ben. It kind of fits right in line with what you were saying about trends with COBRA and healthcare.gov. But yeah, how would you wade into answering that question?
I would say, first of all, congratulations to Ed and his spouse. That is an impressive accomplishment to be able to save as aggressively as they have and be in a position to be considering this.
I would say it, and it doesn't happen by accident. I've seen a lot of Eds, and for those of you that do look and say, "Oh my goodness, I would love to be there," start planning. And you've got to look at how all 6 areas of your financial life intersect. Ed's question really shines a spotlight on retirement planning. That's one of them. And if you've got the green light to retire at 57, that's fantastic. But you need to know your present financial position, cash flow. You need to know your protection plan. That's the health insurance. We're going to talk about tax planning and how your taxes need to be considered. And so, yeah, it touches all 6 areas. So get started right now. So, yeah.
So we'll spend this time primarily talking about the health insurance piece, but touching on that as well, Mike. This is a conversation that ultimately is best had with a certified financial planner, because of it is not just a health insurance decision that we're making at this point. But for the health insurance piece, like we talked about earlier in the segment, COBRA is an option for 18 months. And so we're really looking at, if an age 57 is the retirement date, then we're still going to have 5 years that we're going to need coverage for. So when I meet with people, what I will tell them, for most people, most of the time, it makes the most financial sense to have the lowest monthly cost possible, the premiums that you're paying in exchange for some higher potential costs.
Okay.
So a marketplace plan might give you a lower monthly premium than a COBRA option, depending on what your finances look like, what kind of tax credits that you qualify for. That's one piece. There are the unexpected costs, the deductibles, the max out of pockets that would need to be based on your specific situation, Ed, and yours and your wife. So if you were in the process, if you had some type of large medical expenses, one thing to consider is the timing for that retirement as well, because if you retire in the middle of the year, you would have had medical expenses potentially applying to the plan that you've had while you were working, that if you elect COBRA, you continue that same plan through the end of the year. So it could be a short-term solution to get you to a new calendar year so that your deductibles don't reset in the middle of the year. Because as soon as you change to a healthcare.gov plan, it's starting over at zero.
Okay, well, can I ask you, and I think I'm interjecting here mid-thought, but I had not considered that. So if this, let's say they're retiring middle of the year, and they've already got a few grand towards their deductible already hit. Could they elect to stay on COBRA through the end of the calendar year 2026 and then switch to healthcare.gov during open enrollment?
Yes. Yeah. So between November 1st and December 15th, you'd have the ability, it's every year, you'd have the ability to join a plan on the marketplace or healthcare.gov without passing any medical underwriting questions. They're guaranteed issue plans. You get that every year, or when you would drop employer coverage.
Yeah.
So you could choose to join that in the middle of the year if you didn't have any medical expenses and you were looking to save on some monthly costs.
So retirement's a qualifying event where you have a choice, but then you'd also have a choice at open enrollment.
Yeah.
Okay, great. Yeah, keep going then.
So that's going to be one consideration. Another one when we're talking about warmer climates, it kind of depends if you're talking within the states or internationally. So if we're talking internationally, our recommendation is 90% of the time to get a foreign travel policy on top of at least a marketplace plan or Medicare even. So that's one piece. My assumption is potentially we're talking about within the states. And you're absolutely right on the marketplace or the healthcare.gov. Most of them are HMOs, which have far more restrictions on the doctors that you can see.
Okay.
And employer plans or the COBRA, which is the exact same coverage that you've had, are typically PPOs, so you have more flexibility on getting access to doctors. Talking about networks, if you're in an HMO, it's going to be the strongest in the state that you're in. There are going to be some options outside of that state. PPOs, it's going to be more nationwide. But in the event of an emergency, if you're traveling to a warmer climate, you have to go somewhere, then the marketplace allows for you to go to the closest hospital to get the care that you need, and it would be treated as in-network rates.
Oh, is that emergency room only, or is that any urgent care?
I would say emergency room only. So if it's essentially if it's life-threatening, you don't have any other option, you better go. If it is a situation where you've got a cold and you need an antibiotic, they're going to say, well, you probably should try put a little bit of elbow grease into finding an in-network doctor.
Interesting. Okay, so I'm hearing sort of 3 votes for, without knowing Ed's situation fully, 3 votes for, hey, COBRA might be the best option. And that is, 1, you likely are not going to be able to qualify for the premium tax credits now with this cliff. Work with your tax planner, your CFP to see if you can. But if not, maybe stick with what's familiar in COBRA. That's 1. And 2, you might have some deductible spend or some towards your max out of pocket already by the time you retire. Sticking with COBRA will sort of extend that instead of resetting it. And then 3rd, your COBRA likely is going to be better if you're I was assuming staying within the states as well. That's what he meant. Yeah. But will likely be more flexible out of state.
Yep, absolutely.
Right? Now, one of the things at age 57, we've seen this a lot where in order to be able to retire at that time, you've got tax diversification. So you've saved up a lot into maybe pre-tax, but you've also got dollars in Roth. But the other thing about age 57 is you're not age 59 and a half. And thanks, Captain Obvious, but you know what I mean by that. And that is that you're still too young to have free reign of drawing dollars out of your retirement accounts. Now, we don't know, Ed, if you are leaving a chunk of dollars in your 401k. And because you're retiring on or after turning age 55, you can draw some of those dollars out. Or if you being retired at 57 means that you've got some dollars, some of your nest egg outside of tax shelters. And if so, using those dollars to live on until you turn on Social Security or whatever may mean your taxable income is very, very low. And so, Ben, I feel like the wild card here is if Ed and his wife have a chunk of dollars in cash or in a brokerage account that they can touch. Maybe that has just a little bit of interest and dividends landing on their tax return, but otherwise a pretty low taxable income, that could completely tip the scales.
Absolutely, yeah. Yeah, we get some really low price plans available if you fall within those thresholds for
And then it would just be discussing, well, what are the tax planning strategies to keep your income low, and then being aware of those, challenges with HMO and that sort of thing.
Yeah.
But I tell you, I mean, even with that, you mentioned with the timing of the retirement plays a big role, because even if the plan is to live off of some cash or non-qualified assets, well, if they're going to earn well above that 400% of the federal poverty level before he retires in 2026, then even if your income's really low after retirement, you're still not going to qualify. So a lot to consider. Yeah. Anything else that maybe hasn't been considered yet? I know you mentioned that even if you go with COBRA, you're still going to have 5 years or so, or healthcare.gov. Any other considerations that maybe haven't been brought up yet?
We've started to see a pretty big increase in individuals who are considering share plans as well. There are a couple flavors of those, some that have a faith requirement, some that don't. But for people in that situation, well, we were paying $400 a month and now we're paying $2,400 a month, and we don't have COBRA as an alternative. We do try to have something that we can talk through as an option for folks. Now, it's not insurance, so there are all those types of disclaimers that come with it. It's not actually something that we can even directly help with, but we're trying to educate, to say, hey, well, instead of paying this much, you could pay half of that, and that might mean that you've got a little bit more exposure. But how much risk are you willing to assume in exchange for those lower monthly costs?
Not a recommendation, and yet it's an option, right? And you got to explore those options working with your CFP. And then just going back, I mean, this we mentioned your protection planning. That's where you're making insurance decisions or risk management decisions. That's one of the 6 areas of your financial life. But even with this one, right, it's connected obviously to retirement planning, which is another area, tax planning, present financial position, even investments as well. So clearly touches 5 out of the 6 areas of your financial life. That's why you need to be working with a CFP that's helping you with all 6 areas, and that CFP collaborating with health insurance experts like Ben, so that you can take your next wise step in your financial life. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on our team. Find us online, wisemoneyshow.com, also Korhorn.com. That's Korhorn with a K. All right, there you have it. Go out and take your next wise step in your financial life.